Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Kind of a special show today, actually. We're going to be talking a lot about the banking crisis and just kind of some of the thoughts and solutions and things along those lines. Lots of questions that came in this week asking about that for obvious reasons. But our main emphasis of the show is to answer your questions, try to help you understand, the area of finance, how to invest money, retirement planning, tax planning, those types of things. Really trying to help people get a better sense of how to create a better retirement, at least financially. And so we do that by answering your questions. You can send those in. If you're interested in trying to ask questions today, please do it, and we'll try to answer them live. Send to Ask Tom with talkmoney.com right here on the screen, or you can put them in the chat if you'd like also, and we'll be able to, see if you can answer those questions as we go. You can also subscribe to this channel. That way you get notified when the show starts. You can hit the little bell button if you want to get notified when we put new content on there. And really, we have over 1,000 videos on the channel now that are really, I think, a resource for how to improve your retirement financially. And then, of course, if you have questions specifically that you want to ask us, you can meet with Ethan and I for 30 minutes on the phone or video. Just go ahead and go to our website. There's a link there. There's a book appointment button. Looks just like this. That'll come up, and you can schedule a time that works for you. We'd love to sit down and talk with you, about your specific issues. So look forward to today's show. Hopefully somebody can get something out of this, and you can use it going forward as far as that goes. We do always like to start off the show with a summary of what we saw happening in the market this week. And it's been a pretty incredible week, actually. Even if we just go back, we have to include the weekend now because one of the banks that actually was closed on Sunday, of all places. So the Federal Reserve, the Treasury, everybody was busy this weekend. So, of course, last Thursday, Friday, Silicon Valley National Bank closed down. We'll talk about some of the reasons for that here as we go. And then Signature Bank closed on Sunday. And so it's interesting. If you look at the stock market there, you'd expect to see a much worse result. Yeah, I mean, we have had a drop that came down. We peaked out about a month ago and kind of been bouncing along. We tested that trend line again, which isn't unusual. The trend line technically held there, and we bounced off of that. Kind of a normal looking motion. Most of that downward motion was about inflation, the hot numbers that we started to get for inflation and jobs in January. And here we are, with a market that's up a little bit. And let's talk about why. If we look at kind of the 5-minute chart for the week, it's an upward week. I mean, if you would have asked a lot of people at the beginning of the week, hey, these two banks have failed. There's rumors of other banks. We're starting to see the regional banking indexes dropping like a stone and all these things.
And spread to international, too.
Eventually spread to Credit Suisse, internationally. So, and here we are. We have an upward motion week. Now, you can see it's a pretty big roller coaster ride to get there. And so really what's happened is that the federal government and the Swiss National Bank, in the Credit Suisse's case, have stepped forward with a program to be able to try to kind of backstop the deposits that are in these banks. So they let Silicon Valley Bank close, they let Signature Bank close, the shareholders in those institutions and the people that had bonds, of those institutions pretty much got wiped out. Yep. But all the depositors were made whole. And this was kind of an important component because so many of the depositors, especially at the Silicon Valley National Bank, had more than $250,000. What was the amount that you looked up?
So because Silicon Valley Bank caters so heavily to startups and tech-centric firms in the Bay Area, 90% of their depositors were above the $250,000 insurance limit.
Yeah, so there was some great consternation there as to what was happening. And again, if we would have taken a survey at the beginning of the week after these things have happened, on the late last week and over the weekend, wouldn't have guessed that the market would go up. And so this is a really important component I want to make sure I cover, because one of the things that happens when you're looking at, investing is that there's really kind of two ways to do it. One is you make some type of projection. Okay, the market's going to go down because of this banking crisis. So I'm going to react to that projection, and I'm going to reduce my exposure, whatever it might be. And so most of the articles that you read out there are about projections. It's what we all want. We all want the crystal ball. We want to find out, when something's going to happen. I get asked all the time in our appointments, what do you think about this or that? And the second methodology really for investing, in my opinion, is kind of a reaction. All right. So what I do is I look at the price and we react to that price. So in other words, as the market moves and that price changes, we're reacting to that. The concept behind that is that the information is in the price. So last week, markets coming down, find out at the end of the week, maybe Silicon Valley Bank was part of the reason it was coming down even in the beginning of the week. This year, markets going up because the governments have been backstopping these banks. And so that's very hard to predict. And the reason that predict investing tends to do poorly is because most predictions are incorrect. And so our success has come from kind of watching, day by day, minute by minute, and reacting to what happens and what happens with the price. And so we'll talk about our signals and how that works and how our triggers work here in a moment, because I've been asked to try to communicate more effectively, what our triggers, are at this point in time. And I use a, red, green, yellow light system within the practice to kind of do that. So, but let's just talk about the banks for a second here and what's going on. So Silicon Valley Bank had a lot of longer term bonds, okay? Last year was a horrible bond market, one of the worst ever. Really, going back, like the 10-year Treasury last year had as much drop as it did the last time it happened was 1788. So that's kind of amazing. So what happens for a bank is they have this capital requirement. They take your money in, different lengths of time, but mostly shorter term, checkings and savings and all those things. And then they basically put their money out longer term. They'll lend it out as a mortgage, or they'll buy bonds. And so, they'll buy a 10-year Treasury bond, even though the money that you have in your checking account, you could get out tomorrow. And so that's where the banks can get a little shaky sometimes. But they're required to have a certain amount of money on hand, the capital requirement. And so they look at the value of those bonds. And when the value drops substantially, all of a sudden they need more capital. And that's exactly what's been happening since the beginning of last year. Is they've been fighting interest rates. The value of these bonds have been dropping. And so what they call par value is $1,000. So essentially what that means is if you buy it brand new, new issue bond, you'd pay $1,000. It can change in price. At the end of the time, maturity date, you get back your $1,000. And in between times, you've made this interest. Okay? So that's the basics. So in between times, the values have been dropping. The banks are still required to make up that differential, and they can't wait for it to come due 10 years from now. And so Silicon Valley Bank decided that they would make up the capital by issuing some stock. Unfortunately, that just notified Wall Street that they were having a problem. And of course, they're plugged in with a lot of venture capitalists because here we are in Silicon Valley, and there were several of them that recommended to their clients, hey, maybe you want to get your money out of Silicon Valley Bank, and they had a run on the bank essentially, and they ended up having to, the feds ended up having to seize it.
Yeah, it's kind of like when you think about it, a gym. We have, a gym may have like 1,000 memberships, but if everyone goes at the same time, the gym doesn't work anymore. And the bank is a very similar idea. Is if everyone pulls their money at the same time, they don't have the money anymore. So they keep a certain percentage. Let's say the percentage is 10, and so then they use that money. They keep 10% of your deposits, and then they kind of use it for investments or loan it out to someone else, and it kind of multiplies the money. And so all the banks do it. They lend out money. And the system's built around trust that you can get your money out. Yeah,
exactly. And that was the big deal. Because what happened here is although they closed those two banks, there were other banks that were struggling. And so the Fed, the Treasury, and the FDIC got together over the weekend and created this fund. And they used, it's called the deposit insurance. I won't get too much into that. But what happens is that they decided to kind of backstop those those two institutions specifically, they said even if you have more than 250,000, we're going to give you your money back. That was a big deal. Some of the companies here in the Valley had a lot of money at the bank. They want to get that back. But what they did is they opened up a scenario for the rest of the banks where they can borrow fairly easily. So in that way, they don't have to run off to the stock market and notify everybody that they're in trouble. They can borrow, and as collateral, they can take their bonds, which have now come down in value. So if $1,000 was par, maybe it's worth 800. They can use the $1,000 par value as the collateral for the loan. Because what's happened is these banks, this is theoretically temporary, right? Mm-hmm. It's worth 800 now, but once it comes due, it'll be worth 1,000. So the Fed is going to lend that money out to fill that gap, and then that kind of gives that liquidity to those banks. And so that's a really good thing. I think it's a pretty good idea. Because it is a loan, it's not a giveaway, and it's not taxpayer money because they're using this bank insurance. So far, I think it's fairly well, thought through. And we did have one problem this week, and we saw some of the big run-up here that's just over my head actually happened because they kind of solved it. So First Republic Bank was really struggling, and the reason they were struggling is because they have a lot of municipal bonds. Well, municipal bonds weren't part of that backstop program that the Fed and Treasury and FDIC created. So they couldn't go there and lend money at par value for these bonds. So 12 banks got together and literally deposited $30 billion into First Republic. Mm-hmm. So that's good for them too, in a way. The money's still there theoretically. They're just putting liquidity in there. And that allows First Republic to then meet its capital requirements and have that cash on hand. So that's how they got around that. And so I think a couple of things that I think are really important here. Number one is lots of questions about what about my money? I have $80,000 at this bank or at this credit union, and so if it's under 250,000, you're backed, right, by the government, and so that's important to understand at banks and credit unions. Now, ideally, you probably want to be at one that is doing better than another, just so there isn't some interruption, as far as that goes. But for the most part, that's going to be very difficult to tell. And right now, because they've got this lending capability, it does allow for quite a bit of liquidity to come into the banking system.
Yeah, and this bank run kind of came from fear that you wouldn't get your money out.
Yeah.
And so it's essentially because all these, the banks that are having trouble are the banks that kind of cater to people that keep more than 250,000 in their accounts. So if you have to do payroll for a startup, you're likely going to pay out more than 250,000 a month. So you have to keep that money on hand.
Yeah.
And so if the bank goes under, you lose that money. And that's the big issue. And that's what caused that run.
That's right. Okay, so this brings us to the question that we were getting is what do we do about this, and how do we react to this, and how do we make sure that we're safe in this environment and all of these things? Because what's happening here is that this is bringing on the fear of what happened in 2008. And so a couple of things, and this is just my personal opinion, but 2008 is something I've studied tremendously. I lived through that. And what happened was we were bailing out, backstopping different institutions that were struggling during that environment. It was a much different environment. It wasn't an inflationary environment. It was literally a recessionary environment, which we're not in at this point in time. But they all of a sudden stopped backing one institution, and that was the Lehman Brothers. And there was a reason for that. They just bailed out Bear Stearns. All right, so they were working on it. The Treasury and Federal Reserve got together with the Lehman Brothers, and they were having a conflict. The CEO of Lehman Brothers wasn't doing what the Fed wanted them to do. And so they decided to let that one fail. What they didn't realize was that it was essentially a house of cards built on these credit default swaps and all these other things, and the market really fell. And so a couple things happened. First of all, there was roughly a 30% drop in the market after that. Nobody wants to see that again. Number two is the government did end up doing all kinds of stimulus. If you guys remember the TARP bills and those types of things, roughly $7 trillion was spent, kind of getting the economy going again after that big fall. theoretically they could have put out that 150 billion to Lehman and maybe avoided that. So that's kind of in the back of the mind right now. The other part is purely political. That transpired in an election year, presidential election year, and really swept the Republicans out at that point in time. Obama came in, Democrats controlled both, House and Senate at that point in time. And so here we are kind of heading into another election. We've got the White House who controls the Treasury, the Federal Reserve to a certain degree. I won't say control, but they all want the same thing here, which is to try to create this stability. So there's less chance of a 2008 scenario from happening right now, in my opinion. Now, it can happen. Something else can happen. Things can happen internationally that the U.S. can't control. So we did see this week inside of this chart here, matter of fact, part of this downturn that transpired was Credit Suisse, right? Huge bank. And been having trouble since 2015. I mean, 18, for a really long time. And so they have the Saudi National Bank is their biggest shareholder. They've been giving money to Credit Suisse to kind of help them out. Finally said, nope, we can't do any more. And that's when this downturn started that you see right here, kind of the middle of the week. And what happened was that the Swiss National Bank, basically their form of the Fed Reserve, offered to lend money, 54 billion, which is a lot of money. So that's interesting. And then today we have a downturn that's going on, right? There's a lot going on here. So the downturn that's happening today has to do with two things. Number one, today is triple witching day. Okay, so this is the option expiration Friday. You generally can kind of ignore, in my opinion, some of the results that happen on these types of days, just because it is just such a weird environment and all these option expirations. We'll see what happens next week, really, if you want to kind of know. But there was one other thing. This lending program that the government set up, this week the banks went in there for $154 billion here in the U.S. That's the most ever, more than they took out in 2008 during that particular crisis. So that's making the market think, is this liquidity crisis bigger than we thought? It's not just, First Republic and Signature Bank and, Silicon Valley Bank. There's obviously other banks that are looking at this and saying, okay, hey, we need this liquidity also. Now, I've heard that there's up to $1 trillion, or read that there's up to $1 trillion that will be available. Again, there's a political will here to make this work and not have it turn into 2008, so we don't have more bailouts, so we don't have more change of party, right? I mean, maybe some of you want the party to change or they don't. Irregardless, that becomes part of the calculus as they're working through this. So I think that's all very interesting. The other thing to be aware of here at the end of the quarter, if you remember at the end of the year, I was talking a lot about the fact the market's coming down here at the end of the year because these big target date funds and pensions are rebalancing. They have a target for X amount in stock and X amount in bond on a simplified basis. And then they rebalance those at the end of the quarter. So if you look at from the middle of September to the end of September, the market dropped a lot. On October 1st, after the quarter's over, it started back up again. Here we went, the end of the year, dropped the last 2 weeks, and then January, we had a pretty nice run, yeah? And so here we are again. We're at the end of the quarter. And so what happens is, it depends on what happens between the disparity between stocks and bonds. There hasn't been as much disparity this quarter. It might not have as much impact. But you have to be very careful with, what you're looking at right now between triple witching options expiration and the last 2 weeks of the quarter's rebalancings that are happening. Be careful of making massive assumptions about where the market might be going here, whether that's up or down, because you can get these kind of convoluted data points that happen. So that's what's been happening. It kind of describes all the pieces. There's an awful lot going on this week. It's worth looking at. I would say, I'm feeling okay about a 2008 type contagion at the moment. The market is too. You can see that because it's up. And obviously, if you have under 250,000 in these institutions, then that's not a bad thing either. You should be okay. You've got a backstop from the government as far as that goes. So now I want to talk about kind of something that was asked of me, which is just, can you please communicate in some format, where your thought process is on different aspects of the market? And so I've made it, and this is wildly simplified, but what I've done here is I've got a green, a yellow, and a red light system. And I'm going to put this up every week and show you where we are. And I'm going to also put this into my daily videos. So if you want to see day by day, whether these signals are changing, you can watch the daily videos that I put out. We started doing the daily videos on the 22nd of March, 2020. And we did it because the market was falling apart and clients were getting nervous, and I was just trying to show some of the positive things that were happening at that time. Turned out that the next day was the low for the year, which was the 23rd of March. So we've been doing this for almost 3 years. I probably miss maybe 15 days a year, so we put over 240 videos a year out. So you can watch those, and I'll start incorporating these signals in there. And so very simply, if it's green, then we want to be in the market. And we really want to look for things that are having great momentum right then, maybe even outperform the market on that upward run, and we want to kind of go with that. If it is yellow, we actually want to reduce the risk of the holdings, still want to stay in the market. Maybe we're using utility stocks or consumer staples or high dividend stocks, and still staying in. Mm-hmm. If it is red, then we really want to reduce the exposure to the stock or bond market and move more towards like a T-bill type ETFs and those types of things, okay? So there's two trigger speeds. One is fast and one is slow. So we actually have two programs. So the fast one is ideal for the IRAs, the Roth IRAs, and those types of things. Historically and in back testing, we have higher rate of returns out of our faster triggers than our slower triggers, but it creates a lot more transactions. So the slower triggers are designed more for those taxable accounts where you don't want a lot of transactions, you don't want a lot of tax consequences if possible, and you don't want to have to record all those on your tax return, right? In both cases, we do not have commissions any longer to buy and sell these ETFs, so it's kind of nice, but the tax consequences for that taxable account is why we have that slower trigger. And then there's, of course, two asset classes, stock and bond. And so what it looks like is this. So here's our current signals right now, okay? Our faster trigger is green for stock and green for bond. So we're fully invested in our IRAs and Roth IRAs. We got that trigger on Tuesday, okay? Turned out okay, market was up. Again, we're reacting. These lights turn on and basically are reacting to what's happening within the market. We're not predicting what's going to happen. Otherwise, we probably would have been out of the market after this weekend because of the bank's failure and what have you. So now things can change. Things could get worse. Those could turn red pretty quickly, okay, because it's a faster trigger. The slower trigger, actually the stock is red right now, and the bond is still green. And so on the slower trigger, these are taxable accounts. We will be moving, as long as it stays red, slowly but surely towards T-bills. Now, we have secondary issues, and again, I'm giving you a very simplified look at this, and we haven't made much changes yet because the market is going up, right? It's been up for most of the week, and so we need to see a little bit of deterioration in the current time frame to go with that trigger before we do something. And again, we're trying to reduce exposure to the number of transactions in the slower trigger. So again, these are things that will broadcast across the bottom of the show on a regular basis. You'll see that come up. And then I'll put that into the daily videos also. If you want to watch those, you can kind of see what's going on. But again, for all the consternation that's out there, 3 out of the 4 scenarios right now that we have are green, right? So I think that's important to understand. Again, we'll show it to you day by day so you can see how that changes. All right. The last piece here is just the 2-year Treasury note. And so, that's the wrong chart. I'll switch back to our two-person base. Just talk about the 2-year Treasury note. So not that long ago, about a week and a half ago, it was hitting 5.1% on the yield. It got all the way down to 3.8%. Mm-hmm. Right now it's sitting around 3.94%. And so there's a couple things that are really significant there that I think are good for the stock market and good for the banking system. Number one is because of the kind of the fear of what might happen to the economy, you started to see people dumping money into treasuries, because that is one way. If you don't want to have your money in the bank, you can directly buy a U.S. Treasury through brokerage firm. We can set that up for people, and we have in the past. And what happens then is when there's a bunch of buying, the price of the treasuries go up and the yield comes down. They go in the opposite direction. And so think about that for a second and why that's important. Number one, the price of treasuries is going up. The banks are struggling because the prices have come down so much. It required this bigger capital requirement to meet their capital requirement needs. As the bonds start coming back up, there'll be less need. So that will help actually, at least in the short term here, support the banking system. The second thing is that it creates a lower competition for the stock market. When you can get 5.1% on a 2-year treasury versus an 11% average stock market return, more money is going to go towards treasuries and those types of things than there is the stock market. And so that is a problem for the stock market. But when the rates come back down, the stock market has more money that might come back. Because again, I get 3.9 or I can make more money long term in the stock market. That's the theory, right? So both of those are actually pretty positive, and I think that's a really big development right now that's been going on too. So it's a very, very interesting time frame. We have to wait and kind of see what happens and see how these things play out. But again, I think one of the things to keep your mind on is that the U.S. and the rest of the world was able to kind of put out enough stimulus money to stop the possible depression that would have happened from the 2020 shutdown worldwide. Airline miles dropped by 96%. All these things were happening. Restaurants were closed. And they not only managed to keep us out of a depression, they actually probably put out too much money. And they were able to turn around the economy, eventually, but the stock market just took off, right? It was a fantastic year for the market. And I think that there's enough will out there to continue to support this banking system here. If they have enough capabilities to get us out of the pandemic, they have enough capabilities to do it here. Long term, that's going to be interesting, right? I worry about the long-term aspect of these types of kind of bailouts and backstops that are happening. But right now, in the short term, I think that we're okay as far as that goes. Let's just watch and see how this plays out. We'll need to watch what's going on internationally, those types of things too, and see how it plays. But very interesting time frame. I'm super glad that you could join us today and be able to kind of see, what's going on, and we'll be able to, meet with you again next week and cover this again. Thank you. All right, so let's take a look at the first questions.
So the first question came in from the chat. I just want to address this quickly.
Yeah.
From John, have you begun to reinvest into SOX, SOXX, the ETF?
SOXX. Yeah, actually, SOXX was purchased on Tuesday, and it's done well. It's actually probably done the best of the ones that we did invest in. Just so you know what SOXX is, it's the iShares Semiconductor Index. And we've been in and out of it over a period of time and haven't been in it for a while, but we were at the beginning of last year. But yeah, as of Tuesday, I don't know if we'll stay in it very long. That's mainly our kind of our fast trigger, motion. So it really depends on the overall market, because we will factor the overall market more than the individual holding. In this particular case, the concept that the rising tide raises or lowers all boats, right? So if the market's falling apart, it's going to be really hard for that semiconductor index to do well. Actually, generally it does worse because it has a higher standard deviation, a higher beta than the market, and it tends to come down. But yeah, when we're riding on an up motion like we're getting right now, we'll ride that and see where that goes. And you never know. I mean, this could be the beginning of great things because of all this liquidity that the government just put into the system. I mean, this is really important to understand. I mean, the banks borrowed $154 billion. Well, that's money coming into the system that creates liquidity. It does create problems from the inflationary front. Yeah. And so that's the one thing we're going to have to deal with here. The Federal Reserve and all the Federal Reserves in the world, look at this the same way as far as I'm concerned. They bifurcate the system. So on one hand, they've got a group that is organized around trying to save things if they break, like what happened with the Swiss National Bank. On the other hand, got a thought process, hey, we got to bring down inflation. And they'll let those run separately. Sorry. Excuse me. So the ECB raised rates by 0.5 point.
Yep.
Sorry. You fill them in. Sorry.
Yeah, and so with the triggers for your more aggressive accounts, you're going to go into something with a more high standard deviation. And so when our trigger triggered on Tuesday, we moved into SOX, which was one of our. We have a list of accounts or positions that we kind of follow, and then whatever's kind of that momentum based, what's performing the best.
Yeah, it's a good point. We don't have stocks in portfolios below 80% stock, right? So if you got a 60% stock or 10% stock, we don't have semiconductors in those portfolios just because it moves too much,
Yeah.
So that's one of the bifurcations. We have 10 different risk levels that we deal with. So good question, though. I think it's a very interesting area. It's part of sort of the infrastructure build out now will be the semiconductor arena. There's some great potential there, I think, long term for certain. Again, that is something we're looking at on a shorter term basis.
So this is another question that came in through email from one of our clients. How do we prepare for the debt ceiling not being raised? Did it not cause a financial recession and the markets to roiled? And how do we protect ourselves?
Yeah. Okay. So the debt ceiling. There's another thing that some of these things. I mean, just in the last 2 weeks, we've had job reports, we've had the CPI reports, we've had all these things. The debt ceiling's still hanging out there. It's all getting kind of obliterated news-wise by what's going on in the banking system, rightfully so. But the debt ceiling is a big area. It's a political football that gets kicked around. Here's the outlook on the debt ceiling and then what we would do about it. Number one is if you go back to kind of the first time it was really employed was 2011. The market dropped 17%. That's a pretty big drop. As people were worried, what would happen. And in that particular instance, they actually downgraded the U.S. debt, which ended up costing, I forgot what the number was. I think it was $1.8 billion extra interest income for the U.S. because of that fight, which was really kind of a shame. We got them finally, reestablished a higher rating with the bond rating companies. But just if you look back, we've had several of these now. If you look back to 2021, so we had one in, I think, started in September of 2021, where there was a holdout and the market dropped 10%. So not 17, but 10. Then we had another one, essentially in November, December, market dropped 5%. And so I think to a certain degree, it's a little bit of the, the boy who cried wolf scenario. The market is looking at it as potential buying opportunity, which keeps the dips shallower. This one could be worse. They all could be. Anything can happen. But that's something to note is that far throughout time, when we've had debt ceiling arguments, they've gotten less and less impactful to the stock market. So that's number one. So again, if we're going to make a prediction, right? We'd say, the debt ceiling is going to cause problems and I'm going to get out. And you could be wrong and the debt ceiling could cause virtually no problems and you would have wished you would have been in there, right? So what do? Well, you watch the stock market price like we do. That's what these triggers are. We have a whole host of things that we look at that feed into those triggers. And when we get yellow light or we get a red light situation, then we are going to be looking to try to get more defensive. So it gets to a yellow light. We're moving down in risk in our holdings, where we're buying, essentially lower standard deviation type holdings like dividend paying stocks and utilities and, consumer staples and those type of things. And when we get a red, if the price deteriorates enough because the debt ceiling argument, or for any other reason for that matter, then we're starting to move towards T-bills to protect principal until we let the dust settle and we kind of get back in as far as that goes. So that's how I would be handling it, because it's not just the debt ceiling. It's anything you can think of. It's Ukraine. It's the China situation. It's the debt ceiling. It's the banks. It's whatever will be next, right? If you just kind of continue to watch that price and you have a mechanism to react to that price and make your changes fairly quickly when you need to. A lot of our portfolio we try to buy and hold, so I'm really talking about kind of what we call the target section of the portfolio, where we try to, move that, but even buy and hold at some point has some kind of breaking point. You don't want to, I've got clients, well, I just want to hold on to it forever. Yeah, okay, well, in the Great Depression, the market dropped, 85% or 86% or something like that. So your $1 million is now worth 140,000, and it took 14 years to get back. So you got to be careful. Our clients are older too. So a pure buy and hold concept is something that should be a part of a portfolio. I don't have any real problems with it, especially for somebody that's younger that has time to recover. But having some principal preservation built in is not a bad idea.
So this is another question that's come in with emails quite a bit. Is my bank or credit union safe to keep money in? Is a credit union just as safe as a bank, the FDIC insured bank?
Yeah. So we've got a whole bunch of emails on this week, right? Just people that are concerned. All of the people that wrote in that I know of had less than 250,000. And so you are insured by the government through the FDIC for the banks, and then what is it? I always forget the name of the
National Credit Union Association, so NCUA.
NCUA. And so that's also backed by the government for $250,000 per deposit. And so if you have less than that, you're okay at this point in time. Right? Especially right now, the government's even backstopping the Signature Bank and Silicon Valley Bank for more than 250,000. So not that that's a guarantee.
50,000 right now, or can I go to another bank, maybe get like a 3-month CD or something like that?
Right.
Something short term, but still has the FDIC insurance.
Yeah, because you get 250,000 per institution.
Yep.
In the old days, you used to be able to open up. It was per account. So you could do all these weird things. You could have one for your trust, one for your wife, one for yourself, one for your dog, whatever, and you get 250 on each, and then they stopped that, and now it's 250 per institution, and that's my belief, anyways. I'm not a banking expert, but that's my understanding. And nonetheless, if you diversify amongst different institutions, if you have 800,000, you could move that to 4 different banks. You can also open up a brokerage account and buy treasuries directly in that brokerage account, for example. We can help you with that if you'd like. And basically that allows you, if you want to buy that 2-year treasury, that 4.4% right now, you can do that. And then, you're basically directly lending money to the U.S. government.
Yep.
It'll go up and down in value, but at the end,
you'll still get paid.
You get paid, and you get your interest, and it's guaranteed by the government directly that way. Those are some solutions to that. If you have more than 250, if you have less than 250, you're probably okay. It shouldn't be a problem.
So this is not a question. This is something that some common scam that's been run into by some of our clients, and we just want to give you a little warning.
Yeah. Okay. So this came up, and it's one of our clients that got scammed on gift cards, and we talked to the client, and we wanted to know if it was okay to share this information, just to warn other people that are out there about it, and make sure that we've got as much as possible, try to protect everybody, all the clients, everybody that watches these shows. It's a really big deal to us. We talk about identity theft oftentimes, comes up in these questions and what have you. But describe what this scam works and how it works and what happened with this client.
So essentially, a company offered her a deal, just a cable company, let's go with that. And they said, hey, you sign up for X amount of months and we'll give you a gift card to Target. Target's the most common one that's been targeted. And so essentially, but you have to go buy the credit card first.
The gift card, yeah.
The gift card. Mm-hmm. And then you have to then give them the code for it to be, and then they'll refund you. And so the idea was, okay, I'll go buy the card and then they'll give me the money and everything will be great.
Yeah. So this is just something to be careful of. These people are calling. If you answer the phone, and somebody's trying to offer you, and these aren't the Nigerian prince type scams and those types of things. These are pretty common. There's a lot of people that have had this happen to them over the years that I've been exposed to, and so it's just something to think about. If somebody's asking you to put up money up front
Yep.
for something, because that happens all the time. Oh, you won this $25,000 worth of this, but there is a tax on it, so
You gotta pay
you
the
got to
tax.
pay the tax first. So please send in your $5,000 so you can get your 25,000 or whatever it is. And these are the types of situations. They work, unfortunately. That's why they keep happening. They're hard to stop because the people don't even have to be in the country to do it, and so
Yep.
sometimes enforcement can be difficult. I think it's one of those buyer beware things where you just want to kind of understand that if somebody is asking you to put out money before you get something in hand, especially if it's coming in on the phone or email, right? Those seem to be the two bigger
Yep.
areas, but phone more than email. Just watch out for that and be aware, because some of these deals are enticing.
Yeah.
Mean, the clients that this happened to, they're very sharp and very astute about finances, and still kind of went through this, and they're embarrassed by it, obviously, but definitely wanted to make sure we shared it with everybody so that it doesn't happen to somebody else.
Yeah, it plays upon our fact that we want to get a good deal. Whenever we see Black Friday shopping, it's like, oh, good deal, we got to get in there, and this gift card scam plays up that essentially.
Yeah, exactly. All right, well, that's our show for today. I'm really happy that you could join us today. I hope that we were able to answer, some of the questions. Feel free to send in questions again for next week, anytime during the week. Gives us some time to think about it. It's always fun. You can send those as an email to the Ask Tom at talkmoneywithtom.com, like you see here on the screen. Of course, you can subscribe to the channel. You get notified when we start the show, which I think is good. And then secondly, any new content that we put out. We believe that the more you know, the higher your education level is about retirement in the area of finances, the better chance you have of having a more successful retirement in the area of finances. So even if you're working with somebody like us, we have found that the more somebody understands, the better. And so this is a huge push within this particular practice. And then, of course, we're more than happy to try to educate, you one-on-one, answer your questions if you'd like. So you can go to the book appointment button and just set up a time, 30-minute time to meet with Ethan and I, and we can talk to you about whatever it is that you have on your mind or that you need help with, and we'll see if we can help you. So look forward to seeing you again next week. Again, we're going to start doing the signals for the fast motion and the slow motion, triggers on the daily videos. I'll let you know, when things turn from green to yellow to red, etc. So you can kind of follow along with that and see what's going on there too. So again, those videos come out every day. If you subscribe and hit the bell, you'll get notified when they come, and you can see what happens there. So hopefully that helps. Look forward to talking to you again next week. Thank you.